I've told students when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make. In their entire life, they would get very rich because they would think very hard about each one, and you don't need 20 right decisions to get very rich. 4 or 5 will probably do it over time. Right now, I'm looking at something that I haven't seen since 2008. And back then, if you had the courage to act when everyone else was paralyzed with fear, you could have set yourself up for generational wealth. Not comfortable, not well off, generational wealth. Let me take you back to 2008 for a moment so you understand the magnitude of what I'm talking about. The financial system was collapsing in real time. Lehman Brothers had just filed for bankruptcy. AIG, one of the largest insurance companies in the world, needed a government bailout to survive. Washington Mutual failed. Wachovia was acquired in a fire sale. Bear Stearns had already been sold to J.P. Morgan for essentially nothing. Major banks that had existed for over a century were on the verge of disappearing overnight. The stock market was in absolute free fall. People were losing their jobs by the hundreds of thousands. Foreclosures were skyrocketing. Life savings were evaporating. There was genuine, legitimate fear that the entire economic system might come apart at the seams. And in the middle of all that chaos and absolute terror, I was buying, not a little bit, billions of dollars. I was writing checks for $5 billion to Goldman Sachs, $3 billion to GE. I was buying stocks that had been cut in half or worse. And people thought I had lost my mind. Here was this old man in his late 70s who should know better, throwing money into a burning building. Critics said I was too old, that I didn't understand the new reality, that this time was different, that the world had fundamentally changed and the old rules no longer applied. But I wasn't worried about what the critics said. I wasn't worried about looking foolish in the short term. I was focused on the opportunity in front of me. Because I've lived through enough market cycles to know that when there's blood in the streets, when everyone is panicking, when fear has reached a crescendo, that's when you find opportunities that come along once in a generation. Not once a year, not once a decade, once in a generation. If you had invested $10,000 in the S&P 500 in March of 2009, at the absolute bottom of that crisis, it would be worth well over $80,000 today. That's an 8-fold return. But most people didn't invest. They didn't have the courage. They didn't have the cash. They didn't have the conviction. They sold everything they owned, went to cash, and waited for things to calm down. And by the time things felt safe again, by the time the news stopped being terrifying and started being merely concerning, the opportunity had passed. The market had already doubled or tripled from the lows, and they ended up buying at much higher prices or missing the move entirely. This is the pattern I've seen repeated over and over again throughout my entire investing career. The majority of investors do exactly the wrong thing at exactly the wrong time. They buy when things feel great and prices are high. They sell when things feel terrible and prices are low. They let their emotions drive their decisions instead of logic and analysis, and they pay dearly for it. Now, I'm not saying we're in exactly the same situation as 2008. We're not. The financial system today is much stronger than it was back then. Banks are better capitalized with larger cushions to absorb losses. Regulations have been tightened to prevent the kind of excessive leverage and risk-taking that led to that crisis. The economy has different challenges now than it did then, but what I am seeing is a similar setup in terms of opportunity. There are dislocations in the market. There are quality businesses trading at prices that significantly undervalue their long-term earning power. There is widespread uncertainty and pessimism, and that combination, fear plus dislocation plus quality assets at cheap prices, is when fortunes are made. Let me be very specific about what I'm saying, because I don't want this to sound like vague hand-waving. After years of easy money, zero interest rates, and generally rising stock prices, we've entered a period of much greater volatility and uncertainty. Interest rates have risen dramatically from near zero to levels we haven't seen in 15 years. This has profound implications across the entire economy. Inflation, which most people thought was dead and gone, came roaring back and has proven more persistent than anyone expected. Geopolitical tensions are elevated with conflicts and uncertainty in multiple regions of the world. Economic growth is slowing, consumer confidence is wavering, and the market has reacted by selling off many stocks, particularly in certain sectors that were previously high-flying favorites. Now, some of those stocks absolutely deserved to go down. They were built on hype rather than fundamentals. They were priced for absolute perfection. They were speculative bets that never generated profits. Those needed to come back to earth, and many of them still have further to fall. But as always happens during periods of market stress, the market throws the baby out with the bathwater. Quality businesses with strong competitive positions, solid balance sheets, proven business models, and years or decades of profitable operations have been sold off alongside the garbage. And that creates opportunity for those who are paying attention. This is exactly what happened in 2008 as well. Everything got sold. It didn't matter if you were a bank that had made terrible subprime loans or a railroad that had nothing to do with the financial crisis. Everything went down. The good companies, the bad companies, the mediocre companies, indiscriminate selling driven by fear and forced liquidations. And if you could keep your head while everyone else was panicking, if you could look past the terrifying headlines and focus on business fundamentals, you could buy world-class businesses at prices that hadn't been available in years or decades. I bought railroad stocks during that period, Burlington Northern. Railroads are incredible businesses when you understand their economics. They have irreplaceable assets. You can't just build a new railroad network. The rights of way were acquired a century ago and would be impossible to replicate today. They have a natural oligopoly with only a handful of competitors. They move freight more efficiently than trucks. And yet in 2008, you could buy these businesses at valuations that made no sense whatsoever. The market was pricing them as if they might go bankrupt, when in reality, they had strong balance sheets and would continue moving freight regardless of what happened to the broader economy. I bought financial stocks when people thought the entire sector was going to zero. Goldman Sachs, Bank of America, American Express, Wells Fargo. The market was treating all banks the same, as if they were all equally exposed to subprime mortgages and toxic assets. But that wasn't true. The best banks, the ones with conservative lending standards and strong deposit bases, were going to survive and thrive. They might have a difficult year or two, but their long-term earning power was intact. And you could buy them at 4, 5, 6 times earnings, valuations that were absurdly cheap for businesses of that quality. I bought energy companies. Oil prices had collapsed from $140 per barrel to below $40. Energy stocks had been decimated. And yet, the world still needed energy. Cars still needed gas. Planes still needed jet fuel. Factories still needed power. The demand wasn't gone. It was temporarily reduced, but it would come back. And the best energy companies with low-cost production and strong balance sheets were positioned to benefit enormously when prices recovered. Those investments made during the depths of the crisis, when everyone else was terrified, turned out to be some of the best I've ever made. Not because I'm a genius, not because I could see the future, but because I understood something fundamental about investing. When you buy quality businesses at depressed prices, you get a double benefit. First, you get the recovery as the stock price returns to fair value. That can happen quickly, over a year or two. Second, you get the long-term compounding as the business continues to grow and generate returns over many years and decades. It's like buying a dollar for 50 cents and then watching that dollar grow to $2, $3, $4 over time. The returns are extraordinary because you're starting from such an advantageous position. But here's the challenge that prevents most people from taking advantage of these opportunities. It's incredibly, almost impossibly difficult to buy when things look scary. Your brain is wired through millions of years of evolution to avoid danger. When the market is crashing, when the news is uniformly terrible, when everyone around you is selling and panicking, every instinct you have tells you to do the same. To protect what you have, to go to cash, to wait for clarity. And that feeling is so powerful that it overrides logic and analysis for the vast majority of investors. This is why it's not enough to understand intellectually that you should buy during crashes. You have to have the emotional fortitude to actually do it. You have to be able to look at your portfolio declining day after day, week after week, and not only hold your positions, but add to them. You have to be able to watch the news showing nothing but disaster and crisis and see opportunity instead of danger. That requires a level of psychological strength that very few investors possess. I remember very clearly what it felt like in 2008. The criticism I received, the questions about whether I'd lost my touch, the suggestions that maybe at 78 years old, I didn't understand the modern financial system, the worry, even among some of my closest colleagues, that I was making a terrible mistake. And I'd be lying if I said I wasn't concerned at all. When you're deploying billions of dollars in the middle of a financial crisis, when smart people you respect are telling you you're wrong, you do question yourself. But I kept coming back to the fundamentals. Are these businesses going to exist in 5 years, 10 years, 20 years? Are they going to continue generating cash flow? Will they emerge from this crisis in a stronger competitive position? And the answer to all those questions was yes. So what specifically am I preparing for right now? Let me walk you through the areas where I think we're going to see significant opportunities over the next year or two and why they remind me so much of 2008. The first area is traditional value stocks that have been completely out of favor for the past decade, really since the financial crisis. Growth stocks and technology dominated everything. Everyone wanted the next Amazon or Netflix or Tesla. Profitability didn't matter. Valuation didn't matter. All that mattered was revenue growth and the narrative about disrupting some industry. Money flooded into these growth stocks, pushing valuations to levels that made no economic sense. Well, that party has definitively ended. Many of those high-flying growth stocks have come back to earth. Some have crashed 70, 80, 90% from their peaks. Companies that were worth hundreds of billions of dollars are now worth a fraction of that. And while this correction was necessary and overdue, it's also created a different opportunity. Meanwhile, as everyone was chasing growth, boring old economy businesses that actually make money and generate cash flow were ignored. Energy companies, industrial manufacturers, financial institutions, consumer staples companies. These businesses continued operating profitably, paying dividends, generating free cash flow, and nobody cared because they weren't growing at 40% per year. Now, those value stocks are trading at valuations that are extraordinarily cheap by historical standards. Single-digit price-to-earnings ratios, dividend yields well above the market average, price-to-book ratios below 1, meaning you can buy $1 of assets for 80 or 90 cents. These are the kinds of valuations you typically only see during deep recessions or financial crises. And yet, many of these businesses are doing just fine. They're adapting to the current environment. They're managing their costs. They're maintaining profitability. They're not in any kind of distress. The market is just completely ignoring them because the sentiment has been so negative. This is setting up exactly the kind of opportunity I saw in 2008. You have quality businesses, businesses that will exist and be profitable for decades to come, trading at prices that imply they're about to go out of business. That disconnect between price and value is where big money gets made. Not by taking on enormous risk, but by simply buying good businesses at cheap prices and being patient enough to wait for the market to recognize their value. The second area I'm watching closely is small and mid-cap stocks. These have been absolutely hammered over the past couple of years. When markets get volatile and investors get nervous, they flee to the perceived safety of large-cap stocks. They sell their small and mid-cap holdings, often indiscriminately, just to reduce risk and increase liquidity. This pattern has played out again and again throughout market history, and it creates persistent opportunities for patient investors. Many small and mid-cap companies are exceptionally well run with strong competitive positions in their niches. They generate good returns on capital. They have clean balance sheets. They're growing steadily. But because they're smaller and less liquid, they get sold off more aggressively during risk-off periods. This creates a disconnect where a small cap company might trade at 8 times earnings while a large cap company in the same industry trades at 20 times earnings. Is the large cap really worth 2.5 times more per dollar of earnings just because it's bigger. Usually not. That valuation gap represents opportunity. In 2008, small and mid caps were devastated. They fell even harder than large caps, but they also recovered faster and went on to outperform over the following decade. I think we're seeing a similar setup now. You can buy great small and mid-cap businesses at valuations that large caps haven't seen in years. If you have the patience to hold through the volatility and you're not investing money you'll need in the next year or two, I think these will generate excellent returns. The third area, and this is where some of the biggest opportunities might be, is in distressed or challenged situations. I'm not talking about companies that are going bankrupt or businesses with fundamentally broken models. I'm talking about quality companies facing temporary difficulties. Maybe they made an acquisition that's taking longer to integrate than expected. Maybe they're in a cyclically down industry. Maybe they had an operational issue that hurt short-term earnings. Maybe a key executive left and the market got worried. These kinds of temporary problems often create huge overreactions in stock prices. The market has a tendency to assume that problems are permanent and will get worse rather than better. A company misses earnings by 10% and the stock falls 40%. That's not a rational response if the underlying business and competitive position are intact, but it happens all the time, especially in volatile markets when investors are looking for reasons to sell. And for those who can distinguish between temporary problems and permanent impairments, these situations represent some of the best risk-reward opportunities in the market. I made a lot of money in 2008 buying companies that had temporary problems but solid long-term prospects. The market was assuming the worst-case scenario for everything. Any company with any hint of trouble was sold down to absurdly low levels. But if you did the work to understand which problems were fixable and which companies had the resources and management teams to fix them, you could buy quality franchises at prices that reflected terminal decline when the reality was just a bad couple of years. Now, all of this opportunity identification is fine, but you can't take advantage of opportunities if you don't have the resources to act. This is critical, and it's something many investors miss. During 2008, Berkshire Hathaway had tens of billions of dollars sitting in cash and short-term treasury bills. That cash was earning almost nothing. People criticized me for years about that cash position. They said I was being too conservative, that I was missing out on returns, that cash was trash. And then the financial crisis hit, and suddenly that cash position looked brilliant. That cash allowed me to act decisively when opportunities appeared. I didn't have to sell anything. I didn't have to borrow money at unfavorable terms. I didn't have to ask anyone's permission. I could write checks immediately for billions of dollars. And companies that desperately needed capital, whether it was Goldman Sachs or General Electric or others, came to me because they knew I had the resources and I could move quickly. If I had been fully invested going into that crisis, I would have missed those opportunities. The cash gave me optionality and power when almost everyone else was constrained. You need to think about your own situation the same way. Do you have cash set aside to take advantage of opportunities? Or are you fully invested, maybe even using margin? If the market drops another 20 or 30% from here, will you be able to buy more? Or will you be forced to watch from the sidelines, or worse, be forced to sell at the worst possible time because you're overextended? This is why I've always maintained a significant cash position, even when people criticize me for it. Cash gives you options. It gives you flexibility. It gives you the ability to be greedy when others are fearful. But having cash is only half the equation. The other half is having the emotional discipline to actually deploy that cash when markets are crashing and everything feels terrible. This is even harder than accumulating the cash in the first place. When your portfolio is down 20, 30, 40%, when the news is nothing but doom and gloom, when experts on television are predicting that things will get much worse before they get better, your natural instinct will be to preserve your remaining cash, to wait for things to stabilize, to wait for some sign that the worst is over. And if you listen to that instinct, you will miss the opportunity, because the time to buy is not when things feel safe. The time to buy is when you're genuinely scared, but you can see that the underlying value of businesses hasn't been impaired to the degree that the market prices suggest. In 2008, the scariest time to invest was also the best time to invest. The absolute bottom in March 2009 felt like the world was ending. Anyone who bought then, who had the courage to act when it felt most dangerous, made extraordinary returns. This is where having a process and framework really matters. You can't rely on your emotions because your emotions will betray you at exactly the wrong time. You need to have thought through in advance what you're looking for. What constitutes an opportunity? What valuation metrics indicate a stock is cheap? What business characteristics give you confidence in long-term viability? If you have clear criteria established ahead of time, you can act mechanically when opportunities arise rather than being paralyzed by fear or swayed by panic. My framework is relatively simple. I look for businesses that I understand, businesses with durable competitive advantages, businesses with strong balance sheets and financial flexibility, businesses with management teams that have proven they can operate effectively through various market conditions. And I want to buy these businesses at prices that are significantly below my estimate of their intrinsic value. That's it. It's not complicated, but it requires discipline. During times of market stress, you'll find businesses that meet all those criteria trading at valuations you haven't seen in years. Maybe a quality industrial company that normally trades at 15 times earnings is now at 8 times. Maybe a leading financial institution trading at 1.5 times book value is now below book. Maybe a consumer staples company with a 30-year track record of steady growth is yielding 5% instead of its normal 2.5%. These are the kinds of dislocations that create wealth-building opportunities. But you have to act when you see them. You can't wait for confirmation. You can't wait for the valuation to get even cheaper. You can't wait for the news to improve, because by the time all those things happen, the opportunity will be gone. The stock will already be back to normal valuations or higher. You have to be willing to buy when it's uncomfortable, when you can't be certain you're getting the absolute bottom, when there's still plenty of bad news swirling around. Let me talk specifically about some sectors where I see opportunity right now. Energy is one that I find particularly compelling. Energy stocks have been unloved and unwanted for years now. First, it was fears about peak oil demand and the transition to renewable energy. Then it was the pandemic and the collapse in oil prices when demand evaporated. Then it was concerns about inflation and recession potentially hurting demand again. The sector has faced headwind after headwind, and the stocks reflect that. Many quality energy companies are trading at single-digit multiples with dividend yields of 5, 6, 7% or more. But here's what hasn't changed. The world still needs massive amounts of energy, and that's going to be true for decades to come. Yes, renewable energy is growing and will continue to grow, but it's not going to replace fossil fuels overnight. We're going to need oil and natural gas for a very long time to power transportation, generate electricity, manufacture products, heat homes, and do 1,000 other things. The demand is there. It might fluctuate with economic conditions, but the long-term trend is still growth, especially with billions of people in developing countries steadily increasing their energy consumption. And yet, energy companies are being priced as if their products are about to become obsolete, as if demand is going to fall off a cliff, as if they're all going out of business within a few years. That disconnect creates opportunity. I can buy some of the best energy producers in the world, companies with low-cost production and massive reserves, at valuations that imply their businesses have no future. Meanwhile, they're generating enormous amounts of free cash flow and returning it to shareholders through dividends and buybacks. That's a pretty good setup in my view. Financials are another area worth paying attention to. Banks had a difficult period earlier this year with the regional bank crisis. Investors got scared about deposit flight and interest rate risk. Many bank stocks were cut in half, with regional banks hurt even worse. But once again, the market treated all banks as if they had the same problems, when in reality the situation was much more nuanced. The strongest banks, the ones with diversified deposit bases, conservative lending standards, and strong capital ratios, are fine. They're not at risk. They're actually benefiting from higher interest rates in many ways. And yet, you can buy some of these high-quality banks at valuations below book value. Think about that. You can buy $1 of assets, conservatively stated on the balance sheet, for 90 cents or less. And these banks are generating mid-teen returns on equity while paying decent dividends over any multi-year time period. it's very hard to see how buying quality banks below book value doesn't work out well. Either they continue operating profitably and the stock eventually reflects that value, or someone acquires them at a premium to book value because they recognize the opportunity. Either way, you win. Industrial companies represent another pocket of opportunity. These are businesses that make the things the economy needs to function. Construction equipment, factory automation equipment, aerospace components, transportation and logistics. They're cyclical, which means they perform well during economic expansions and poorly during contractions. And right now, with economic growth slowing and recession fears elevated, many of these stocks have been beaten down. But the best industrial companies have such strong competitive positions that they not only survive downturns but emerge stronger. They gain market share from weaker competitors, they improve their operations, they make strategic acquisitions at attractive prices. And when the economy eventually recovers, as it always does, their earnings and stock prices surge. I've made a lot of money over the decades buying great industrial companies during the weak part of their cycle. You have to be patient because the turn might not happen for a year or two. But if you can identify the industry leaders and buy them at trough valuations, the subsequent returns can be spectacular. Right now, I see several industrial companies trading at valuations that assume things won't get better, that we're in for a prolonged downturn. Maybe that's right. But even if it is, these businesses will survive and eventually benefit when conditions improve. And if the downturn is milder or shorter than feared, these stocks have huge upside from current levels. The key to all of these opportunities is focusing on quality. Not every cheap stock is a good investment. Some stocks are cheap because the business is genuinely impaired and may never recover. Some are cheap because they're in permanent decline. You have to be able to distinguish between temporary problems affecting good businesses and permanent problems affecting bad businesses. That requires analysis, judgment, and experience. How do you identify quality? I look for several things. Strong balance sheets with manageable debt. During crises, companies with too much debt often don't survive. But companies with low debt and strong cash flow have options. They can invest in opportunities. They can acquire distressed competitors. They can buy back their own stock at low prices. Financial strength creates strategic flexibility, durable competitive advantages that protect profitability even during tough times. This could be a strong brand that commands pricing power. It could be proprietary technology. It could be network effects where the service becomes more valuable as more people use it. It could be high customer switching costs. It could be regulatory barriers that prevent new competition. Whatever the source, you want businesses that can maintain margins and market share even when the economy is weak and competition is intense. Proven management teams with track records of effective capital allocation. When times get tough, management decisions become absolutely critical. Do they panic and slash everything, including investments that are important for the future? Do they make desperate acquisitions trying to grow their way out of problems? Or do they stay calm, stay disciplined, focus on what they can control, and make smart long-term decisions? The quality and judgment of management often determines whether a business comes out of a crisis stronger or weaker, and long-term structural tailwinds that provide a foundation for growth. Even a great business in a dying industry is generally a bad investment. You want companies positioned to benefit from long-term trends that are likely to persist for many years. This could be demographic trends like aging populations, infrastructure investment needs, the continued digitization of the economy, the growth of the middle class in emerging markets, rising healthcare spending, increased logistics and supply chain complexity requiring more sophisticated solutions. The specific trend matters less than ensuring the business is aligned with something that has legs for decades. When you find businesses that check all these boxes and they're trading at valuations that reflect extreme pessimism, that's when you need to be buying aggressively, not tentatively, not with just a token position, but with meaningful capital that can really move the needle on your long-term wealth. These opportunities don't come around often. When they do, you have to act. The thing that prevents most people from doing this isn't lack of knowledge or analysis. It's psychology. It's the inability to go against the crowd. When everyone around you is negative, when the media is bearish, when your friends and colleagues are selling or sitting in cash. It feels incredibly uncomfortable to be buying. You feel foolish. You worry that you're missing something everyone else sees. You fear that things will get worse and you'll look stupid. But the reality is, the crowd is usually wrong at extremes. When everyone is bearish and scared and selling, that's usually a sign that we're near a bottom. When everyone is bullish and excited and buying, that's usually a sign we're near a top. This isn't just theory. You can see it in the data going back a century or more. Market extremes are almost always marked by extreme sentiment. And if you can position yourself opposite to that extreme sentiment, you'll do very well over time. The way to overcome the psychological barriers is to have a clear investment process and to commit to following it regardless of how you feel or what others are doing. For me, that process is simple. Identify quality businesses, estimate their intrinsic value using conservative assumptions, buy when the stock price is meaningfully below that value, hold for the long term, ignore short-term volatility and noise. That's it. Not complicated. But it requires discipline that most investors lack. I want to give you some very practical advice on how to prepare for and take advantage of the opportunities I'm describing. First, build your cash reserves now if you haven't already. If you're fully invested or close to it, consider taking some profits in positions that have held up well or that you think are overvalued. You don't have to go to 100% cash. That would be extreme and probably counterproductive. But having 20, 30, maybe even 40% in cash gives you the dry powder to act when opportunities appear. And they will appear. Maybe not tomorrow or next month, but over the next year or two, there will be opportunities to deploy that cash at attractive valuations. Second, make a list right now of businesses you'd love to own at the right price. These should be companies you've researched and understand. Companies you believe will be around and thriving in 10, 20, 30 years. Companies with the characteristics I've described. Quality businesses, strong competitive positions, good management, then monitor their stock prices and valuations. When one of them gets hit with the broader market or faces a temporary setback that drives the stock down, you're ready to act because you've already done the work. You don't have to scramble to research companies when everyone is panicking. You just execute on your existing watch list. Third, control your emotions. This is the hardest part and the most important. When the market is melting down and your portfolio is declining, you're going to feel anxious, scared, maybe even panicked. That's completely normal and natural. But you cannot let those feelings drive your actions. You have to recognize them as emotions, acknowledge them, and then make decisions based on logic and analysis rather than fear. Remember that volatility is the price you pay for the excess returns that stocks generate over bonds and cash. Remember that market declines create opportunities to buy great businesses at attractive prices. Remember that every major market decline in history has eventually been followed by a recovery to new highs. This one will be no different. Fourth, think in decades, not days or months. If you're investing money you need next year or the year after, you shouldn't be in stocks at all. Keep that money in cash or short-term bonds, but if you're investing for 10, 20, 30 years, short-term volatility is completely irrelevant. What matters is owning great businesses that will compound value over very long time periods. A 20 or 30% decline in your portfolio is literally meaningless if you're holding for 20 or 30 years and the businesses continue growing. You have to maintain that long-term perspective even when short-term results are painful. The opportunity we're facing now reminds me so powerfully of 2008. Not because the specific circumstances are identical. They're not. Each crisis is unique in its details. But the market psychology is remarkably similar. Fear is elevated. Uncertainty is high. Quality businesses are being sold at prices that don't reflect their long-term fundamental value. And most investors are paralyzed, unable to act because they're too focused on short-term risks rather than long-term opportunities. But if you can do what's difficult, if you can act when others are frozen, if you can maintain a long-term perspective when everyone else is focused on the next quarter, you have a chance to build extraordinary wealth. Not by being smarter than everyone else, not by predicting exactly what will happen, but simply by being greedy when others are fearful. by having the courage to act when the opportunity is obvious to those paying attention but feels terrifying to the majority. I've lived through more market cycles and crises than I can count. Bull markets, bear markets, crashes, bubbles, recessions, booms, wars, peace, every kind of economic and market environment you can imagine. And I can tell you with absolute certainty, based on 7 decades of experience, that the best investment opportunities, the ones that can genuinely change your financial life, always come during periods of maximum fear and uncertainty. That's not unfortunate. That's not a bug. It's a feature. It's how markets work. It's why patient, disciplined, long-term investors can generate returns that most people consider impossible. So I'm preparing, I'm building cash, I'm identifying opportunities, I'm ready to act decisively when the time is right. I don't know exactly when that will be. It might be now, it might be 6 months from now, it might be a year from now. But I know it's coming because it always comes. And when I look back in 5 or 10 years, I'm confident these investments will rank among the best I've ever made, just like 2008, just like 2002, just like 1990, just like every other period of crisis and fear that came before. Because while the specific circumstances change, while each crisis is unique in its details, the fundamental principles of successful long-term investing remain constant. Buy quality businesses at discounts to intrinsic value. Hold for the long term through volatility and noise. Let compound interest and time do their work. It's worked for me for over 70 years. And I'm absolutely convinced it will work for this next opportunity as well. The only question is whether you'll have the courage, conviction, and discipline to act when the time comes. I certainly will be.